Hey everybody, today we're talking about option strategies. We're talking about unlimited loss strategies versus limited loss strategies, and I want to visually compare them to see how much risk we're actually taking. Hey everyone, welcome back to Drawbridge Finance. My name is Levi Woods. I'm not a professional investor. I don't work in the finance industry, and this is an opinion channel about money. Now, for many of my followers, you know that I trade options all the time. And one of the things that I deal with, especially with my patronage membership, is people asking questions about how to limit the risk or how to change the trades that I'm placing so that they can put on a similar trade but with a limited risk factor. And one of the reasons for doing this is so that we can actually leverage ourselves even further. I'll give you a quick example. Like, say we have a trade that's going to use up, say, $3,000 in margin. If we convert that trade to a protected play, one that has a limited loss of, say, $500, then this would allow somebody to put on maybe 6 contracts of the same play, and it would use the same amount of margin requirement. We'd have $3,000 for one contract unprotected, or we'd have 6 contracts that have a $500 limit each, and they use the same amount of capital requirement or margin requirement. One of the things that, for me, that I've learned over the years is that a lot of times the limited loss strategies are really hard to adjust, and I find it a lot easier to actually adjust strategies that are naked or have an unlimited risk factor. So I've been working really hard on a spreadsheet that'll show exactly this comparison and kind of overlay graphically 2 comparisons side by side so that people can analyze those different strategies and see what they're actually risking if the stock moves in a certain direction. Let's dive into it. So first of all, this is the spreadsheet that I've created. You can see there's some data that we need to input in the top, and then there's this graph off to the side, which is going to visually show us the difference between 2 different scenarios. We're going to look at this first column, this yellow kind of section, and that's going to show an unprotected option play, and then we're going to look at the limited risk option play on the right-hand side, and I'll show you how it works. So I'm going to flip over to Interactive Brokers. I've got Etsy pulled up. It's one of my favorite stocks to trade. I almost always have positions on in Etsy. We're looking at October expiration. We're looking at the option chain. And what I'm going to do first off is I'm going to look at a typical strangle that I might put on. So let's look here at the 20 delta, 105 put. So I would probably look to sell something like that. And then on a strangle, I would want to sell the opposing call on it. So I'm going to look down here. I'm going to look for the delta value. I might give myself a little bit more room on that call side because we're in a drifting market that's been drifting up. So I'm going to choose the 17 delta on this side, and I'm going to look to sell the 150 call. That's as easy as a strangle is. We're selling a put that's out of the money. This is our money line right here because that's where the stock closed today at 122.50. So anything below in the put side is out of the money, and anything above on the call side is out of the money. So we're choosing the short selling the 105 put and short selling the 150 call, both expiring October 16th. We can see down here that this has a margin impact in Canadian dollars of $3,262. So what I want to do is I want to see how much money I would make or lose if the stock moved up or down. So I'm going to plug it into my spreadsheet. So a little bit of information here. So first thing we're going to do is we're going to type in the symbol. So we're going to say Etsy. And then the expiration date is going to be October 16th. Fill that in. And then over here, the number of contracts, we're going to say 1. We're going to enter the short strike and the put price. We'll use a mid price, so 105, and we'll say 375. So 105, 375, type this in correctly, $105. And then the short call, we're going to say 150, and it was trading, let's say 218. And then the margin has to be filled in as well. I'm going to do it all in American dollars, so I'll just do a quick conversion. 3262 divided by 1.32, 2470. I'm just going to type that in. In American, it's 2471. And now it's going to fully populate this. So we also have to give it a little bit more information here. We're going to give it an increment for the charting. We're going to put this at $3 for right now. And then the transaction fee, mine is 0. And the fee per option contract, let's just call it $1 because I know that's what a lot of people pay. Now we can see both graphically and in this table how much profit or loss we're going to make at expiration if the stock is trading at a specific price, inclusive of our trading fees. For example, if the stock was trading at $99.91, then we would make approximately $81. If the stock went way down from its current price of $122 down to $51.91, which is highly unlikely, but it could happen, we would be down on this trade $4,719. And the graphic representation of that is here. So we can see in the green line, this is the unprotected option trade, and we can see our zone. We are going to be profitable, somewhere just over $100 and up to about $145 or so. But what I want to do is I want to compare it to a different type of strategy. So the first thing I'm going to do is just limit the loss on this. Let's just make this an iron condor, because that's the simplest thing to do. We're going to copy this information here, paste it over onto the second scenario side. So we've got the same strikes for the short put and the same strikes for the short calls. Then we're going to put in our protective wings. So in this case, let's make it a $5 wide iron condor. So $5 away from 105 is 100. I'm going to enter that, and we need to get a price. It tells me here, it says filling completely. So let me go get that price. It is going to be, we're going to call this $2.55, right in between these two numbers, $2.55. We're never using exact numbers until we actually place the trade. So in this one, I'm going to go $5 wide as well, and I'm going to flip back over here, and it's the 155 is around 165-ish. So we're going to put in 165. Now, these are all entered in positive numbers, even though some of these would be a debit. The long ones would be a debit, these ones would be a credit. They all get entered as positive numbers. And if you try to enter it negatively, it will actually highlight red. I'll just show you how that works. So if you put in, it tells you there's an error. So if you're seeing a red cell, it's because you entered something incorrectly. So 2.55, we'll enter that, and then it'll go back to white. Now, if we put in one contract here, it'll show us this $500 is our max loss. And we know that because both wings are the same distance. $500 between this wing and $500 in this wing. It actually calculates with the commission fees as well. So we can also see how much credit we're initially receiving. On this unprotected position that we first did, this first scenario, it's using $2,471 in margin, but the initial credit that we receive in our account would be $591, inclusive of fees. Once we enter the iron condor, we're paying for this protection. So it reduces our initial balance quite a bit, or our initial credit. It reduces it right down to 169. So quite a big difference between investing a margin requirement of 2471 to make 591 comparatively to a margin of only 500 to make 169. It's hard to get a good comparison. What I want to see is on the graph, now this always shows us exactly what's going on. Clearly, I can see that this green unprotected option is going to be more profitable in all cases, but I'm also taking on more risk. So what I've done is I've included a multiplier in here. And if we look right here, it says estimated number of contracts for similar margin. It's estimating 4.92. So if we just change this to 5, which is fairly close to 4.92, and hit enter, it's going to bring our margin requirement up to 2,500 because we'll be putting on 5 different contracts. We'll also bring up our initial credit, $845 compared to the 591. Now, this is the real key to this, is visually looking at this scenario, because we can now see that if the stock stays in our expected range, we can see that the protected options, 5 contracts, would actually return a better profit. But where it starts to get hairy is when it's outside of that range. And in the blue chart, the protected ones, as soon as that stock moves out of range, it immediately is down at this max loss. So there's a huge zone on this side and this side outside of our expected target zone where the strangle, the naked strangle, performs much better. And what we can do is we can kind of tweak this, and that's what I love about building things like this, is I can say, well, what if I did 3 contracts? How does that work? Well, it's, similar thing. It keeps this range, it brings our max loss to much less. So if the stock was to really blow out, and some of these stocks are quite volatile. I mean, we saw CRM go up 24% the other day. Massive, massive move. And had we had a naked strangle on and something had moved up 24%, it would have blown right past this zone, and it would have ended up out here where we were looking at a huge loss. So on volatile products, it's sometimes really smart to play multiple contracts with protected risk. But there's some other things that happen, and that's what the beauty of this is the highlighting portion of this chart. And so it shows you dollar for dollar how much you can expect to make. So in this case, even though we've reduced our risk, going down to 3 contracts, our max risk is $1,500. So you can use the return on capital column to compare and see, well, capital wise, maybe the protected option would be a better position. There's these small zones where it performs worse with these multiple contracts. So when we look at the return on capital, you can start to compare the 2 scenarios and make up your own decisions as to what sort of strategy you want to take. Now, of course, this is not the be-all, end-all. We should not be looking at one scenario or another scenario and saying, well, that's exactly what I'm going to do in my portfolio. A portfolio should be a blend of different types of scenarios that match to a specific trade at that right time. And it takes a while to learn that and build up our strategy. So this is a tool that you guys can hopefully use to allow yourselves to compare option strategies and find out what the risk is that you're actually taking dollar for dollar. Now, of course, my patrons, thank you so much, patrons. You guys get to download it this month as part of your tier rewards. And for everybody else, if you'd like to purchase it on Etsy, you can head over to my Etsy store where I've got other spreadsheets that help people like you and me make better decisions so we can educate ourselves so we can all get rich together. Thanks so much for watching, and we'll see you very soon.